And this is really how you can piss off your residents too, is if you have too many fees, too many reimbursements, too many additional rents. Welcome to the Ironclad Underwriting Podcast, where precision meets performance in commercial real estate. I'm your host, Jason Williams, and every week we deep dive into the strategies and systems and stories behind rock solid underwriting. Whether you're a seasoned analyst, an up-and-coming investor, or a commercial real estate professional looking to sharpen your edge, this show is your front row seat to expert insights, emerging trends, and real-world underwriting tactics that stand the test of time and scrutiny. From market assumptions to debt structuring, cap rates to cash flow, we're cutting through the noise and getting to the numbers that matter. So sharpen your pencils and fire up those models. Let's get to work. This is Ironclad Underwriting. All right, welcome back to the Ironclad Underwriting Podcast. I'm here again with special guest Frank Patalano. And today, since this is one of the very first episodes, we are going to start from the very beginning and go over some key terms which we feel like every underwriter should know and understand. And then we're going to develop and go deeper into that as the episodes go on. So if you already understand all these terms, you can go on to the next episode. If you don't understand them and want to learn some more, feel free to hang out. So you have something to say, Frank?
I was going to say that obviously this is not going to be hours and hours, but if there's something that someone considers to be a top term or top definition that we're not including today, they can always message you or mention it
Yeah.
somewhere.
Yeah. Once all my episodes go live, I would appreciate feedback and we will start catering these episodes to the audience. So with that said, welcome, Frank.
Thank you,
Welcome,
sir.
audience. And I think probably one of the most important key terms anybody or who understands underwriting appreciates is the NOI. What do you think? I think that's the most important term and number in underwriting.
I mean, that's the first basic math thing that you really need to know. There are some people that if you can give them an NOI, they can estimate a price within 15, 20 seconds, right?
Yep. And we'll get into that later. But in case you don't even know what NOI stands for, it's the net operating income. It's it's basically what your profit is on a property. Um, and so what it is ultimately is all your revenue, which includes all your rent, it includes all of your other income, and we'll get into that here in a little bit. And then you subtract out all your operating expenses, and really that's it. It's like how much money do you have after you make your money and pay all your bills, more or less. So with that, that's a very simple definition, but calculating it can be complicated. And actually, I've seen property managers and other operators calculate it differently than I would, just so they can inflate that number. Because
That is
this number,
definitely, I mean, there's definitely some things you don't put into an NOI. I mean, what do you consider the biggest number or the most important number that you don't put in an NOI?
so I see a lot of operating expenses are modified. Um, I've seen revenues modified, and let's go into the revenue right quick, just so that we can get an appreciation of what all the income comes from an apartment or a commercial property. So the main revenue is from your rent, and a key term for to learn about rent is your gross potential rent. And your gross potential rent is what would your property be paying out if every single unit was rented at the highest amount of rent possible. And that's your gross potential rent. So if you're sitting at 100% and everybody's paying up, everybody's has the highest rent um, going, that's what your gross potential rent is. Now, from that, then you start going into some of your losses. And some of these losses are going to be like your physical vacancy, which is all right. Well, instead of having 100% occupied, I have 3 vacant units or whatever, and I have 100 units, so I'm at 97% occupied. So right now, your physical vacancy would be 3%, or 3 units over 100, or your total units. Another loss would be concessions. Suppose your vacancy is in the 70s or 80s and you're trying to entice people to come in and rent in your facility or your complex. What you might do is give them like half a month's rent or 3 months rent or something to entice them to come in and apply, so that when they get it, they'll get, say, a month free of rent. That month free of rent is a concession because you're not going to be collecting that as rent. So you have to account for that as a concession.
Yeah, you definitely see that on the residential side in tertiary markets or markets that are a little tougher maybe. You see that a lot on the commercial side. Like, I mean, if
Yeah.
you have a retail space, you might offer them the first 2 months free because they need to get approvals, they need to build out, stuff like that.
Yeah, and also a concession is really anything that the owner would supply to the resident for free, basically. And a lot of times with commercial, like retail or industrial, is suppose you need a whole new drainage system because maybe you're putting in an auto body paint shop in the warehouse, but you don't have the drainage system to be able to accommodate that. You can have the owner put that drainage system in there for you before you even move in. And so that could be a type of concession as well. So, and going into that, it's like you have to have specialty drains to accumulate all the paint, and you have to filter it out so that it can go into the water supply and everything. But that could be pretty complicated, and that could be a concession as well. The next one is loss to lease. This is a big loss that I have my students generally have a hard time understanding. And so the way I explain it is your loss to lease is, suppose you increase your rents, say every quarter. You increase them in April, July, October, and January. Okay. Suppose your rent is $1,000, then you're going to increase it $25 every quarter. So if you sign a lease in January, your lease is going to be $1,000, and that's for the full year, right? Then suppose somebody else moves in April, their new lease is going to be $1,025, and that's going to be from April to the end of March. So that's then. So, and then suppose you have someone move in July, their lease is going to be $25 on top of that. So it's going to be $1,050, and that's going to be from July to the end of June or whatever.
No
So,
question.
what?
Say that market rent on an apartment is $1,000 a month, and you decide to sign a lease. You're the owner, and you decide to sign a lease at $975. Do you consider that a concession or a loss to lease?
Um, Ultimately, I don't think it matters if it's a loss of lease or a concession, um, because so long as it's accounted for. And
Definitely.
and one of the two columns, concession or loss of lease. I would probably, if you go in knowingly lease for under market, I would consider that a concession.
Okay. Yeah. I'm not saying you're wrong. That's what I was wondering. I was trying to think of different ways to explain loss to lease to people, and
Yeah.
I was thinking about that.
So going back, so you have someone in July signing for 1,050. So that first person who signed in June or in January for 1,000 is now $50 less a month than everybody else signing after July. So that difference there is your loss to lease. But whenever they come in and sign a new lease in January again or December for the next January, their new lease is going to be, you're going to increase it 25 in October, and then you're going to increase it 25 again in January. So you'll be at the full $100. So you'll be $1,100 in January again. So then they're caught up, and then all the people behind them is where the loss of lease comes in. And you have
Would
to
you,
keep in mind that these leases are generally 12-month leases where you lock in a rate. Now, sometimes you can have a different lease where you say, all right, we're going to increase your rent, whatever we want throughout the whole process. But generally speaking, it's locked in for a year. If you have it for over a year, like a 2 or 3 year lease, you generally would have like an increase in rent, annual increase, but sometimes you don't. Depends on the manager. And I try to avoid multiple year leases if I can. So
would you agree that most people that are starting out their underwriting don't fully appreciate loss to lease? It
yeah,
seems like a lot of people put them at zero, and it's rarely ever truly zero.
yeah. Or some people would just put in just like a flat percentage. Um, Depending on your model, you can really get into the weeds and go through all of your leases from a rent roll, see when they're going out, seeing when your schedule is for your rent increases, so that you can accommodate. All right, well, this guy's lease is up in March, so he's going to resign in April. We're going to be increasing it in April. So but generally, most models I've seen will say, all right, well, we'll just increase it like 4% a year or something like that. So they don't even have a monthly schedule when the increases happen. So you can't really even get into that. But yeah, most people don't understand it and definitely don't appreciate it. Um, Another loss that's there is you can have an employee unit or a model unit or an admin unit. And what this is an employee unit would be, suppose your property manager, your leasing manager lives on site. And so you would give them a unit to live in as part of their compensation, as part of their salary. You're not going to be making rent on that unit, so you have to account for it. It's like, all right, well, we have one employee unit, normally brings in 1,100 a month, but we're letting our employee live there for free because they're doing an awesome job, and so you have to account for that. Or you can have a model unit, and a model unit would be usually it's one near the office, so that when people come in for a tour, you can show them the model unit. They're usually all decked out. They got all furnishings and everything, so it looks like somebody's living there, and they use that as a model so that they can tell you what you'll be getting as a unit whenever they move in. Generally, this has to be indicative of like maybe not the same floor plan, but the same cabinetry, same flooring, same amenities, everything, dishwashers, same appliances, everything you'll be getting when you move in, because you don't want to do the whole bait and switch thing.
Would you agree that you're more likely to see that the larger the property? I mean, if you have a 50 unit, it's probably a lot less likely to have a model unit than if you have a 400 unit.
Correct. Those are going to be generally on your larger units that can absorb an empty unit. Sometimes on your smaller units, say between 70 units and 200 units, you'll have like a floating model unit, but that floating model is not going to be a loss because as a unit becomes available, you decorate it, make it look pretty, use that as your model, and then someone can lease it and then you move it on to another one. And then this next one is an admin unit. And an admin unit could be usually for your smaller properties, um, say like 20 units, 60 units or so, where you don't have like a designated office for the property, but you needed one or you want one. So then that unit will become the office for the property. So
The
those
way
are
the way
one.
we did it on one of our recent properties is we bought townhouse style, and it's 100 plus unit, and we made the first floor the admin or the office, and the second floor the employee lived on.
Okay.
Yeah.
Um, so those are the main losses that you'll see. And so when you're calculating your revenue, again, this is all going back to revenue. So you have your gross potential rent, and then you start um, taking off all the losses because the losses is negative. It's not going to be an expense, but it's taken away from your revenue. So that's where the losses come in. So now you have a gross potential rent, say, of 100,000 a month, and then with all these losses, now everything is about, say, about 10%. So now you're at 90,000. And I wanted to point out, so we mentioned physical vacancy, which is the number of units that are empty. But when you add up your physical vacancy, your concessions, your loss to lease, and your employee or model or admin units, all of those together are going to be your economic vacancy. So your physical vacancy could be 3%, but your economic vacancy will be 10%. And so that's how you figure that. So your economic vacancy 10%, that means your gross potential rent minus 10% is going to be your rent revenue, and then that would be, say, 90,000 a month. And now that's even before we get into any other income. So this is where you can really make or break a property. Other income, um, generally you can't count on it to be consistent. Some things you can. Um, and this is really how you can piss off your residents too, is if you have too many fees, too many reimbursements, too many additional rents. But this is where your admin fees go, your application fees, credit processing fees, legal eviction reimbursement, um, insufficient notice or insufficient funds fee. So if they don't have enough funds to pay the rent and they like overdraft their account and then their bank sends them say, hey, they don't have the money. And then you don't have any money to pay the rent. And now you're charged on top of that to pay even more. So I always enjoy that snowball. Um, and then there's late charges. I never count on late charges because you shouldn't expect your residents to pay late every time. Lease cancellations or reletting fees, month-to-month fees. I mean, there's a bunch of fees that you can come in, and I mentioned some reimbursements. So, if you are master metered property and you want your residents to pay for utilities, you can rub them back. Rubs is a reimbursement utility um, program or whatever, where they would pay a percentage of, say, the electrical bill for the whole complex based on their floor plan, number of people living in their unit. And so they try to do it fairly, but usually it's never fair. Someone's going to take advantage of it. Um, and then there's also, if you have covered parking or assigned parking spots, or you have pet, all of this can be additional rent every month. With pets, generally, I like to have a pet fee that covers, say, like an additional damage deposit for your that does a bunch of damage to your property. But then pet rent would be, say, like $20 or $25 a month just to keep it. And that could be a per pet thing with a maximum of two or whatever. And it could be like you can't have pets bigger than, say, 50 pounds. I mean, you can have all sorts of requirements for that. Um, let's see, any other fees or things? We have on one of our properties, we have high-speed internet coming in, and so our resident pays a little bit on top of that, so we make a little bit of money, not too much, but that covers with that we get charged like 35 a unit, and we charge the resident like 60 or something, and that additional 25 covers the other units whenever we have, say, empty units or whatever who aren't paying it. So
I was just thinking about how obviously different parts of the country have some different fees. So for example, in or even smaller units sometimes. So like the water bill, some places charge, some places don't. I know a lot of places that don't charge a separate water fee or water bill. We've had these discussions many times about the concept of being as much of an all-in-one price
mhm.
versus almost feeing people to death. Some people consider it, especially on the buying side, some people consider it very much of a generator. And I'm not saying it's not, and I'm not saying it's a bad idea, but just sometimes you have to think about your audience or your tenant base and work from there. Covered parking is definitely big in some markets. Other markets, you're not going to get almost any money for covered parking per se. Um, concierge trash. Been seeing that a lot lately. The fact that some nicer properties might have a setup where they actually pick it up right at your door versus, and obviously some of it has to do with the layout of the property itself. So if you don't have a lot of space near your units, then that's one thing. There's other properties that they're basically townhouse style and they're 4 units and the people bring their own trash to the side of the side of the building and they each have their own barrels. So there's a lot of different little fees and ways to generate income if you really need to. Rubs was pretty popular. Ratio utility billing service was very popular in the past couple of years, where some buyers underwrote that as a massive way to make money. And while it might work in like a higher B class property, it all depends on the market. But we tended to notice that, especially in C class, each family or each tenant only has so much money. So if they're going to pay it either way, they'd rather not be separated out and just be all inclusive.
Yeah, they'd rather be able to budget a single payment every month, even if it's higher than what it would have been, just so that they can budget better.
Yeah, just like the concept in smaller properties and triplexes, when you're underwriting or reviewing the deals, the concept of utilities being included versus utilities being reimbursed versus you pay your own utilities and you set up your own bill.
Yep. One thing that we like are charging fees for things where the resident can opt in. So like the concierge service or covered parking or the pets, things that it's not a requirement for the residents, but if they want those features, then they can pay for them. So I know some units you can rent the washer and dryer. So that would be one thing versus going to the on-site laundromat or going down the street to a laundromat. So if you have on-site, that could be an additional income as well, laundry commission. So there's all sorts of different other incomes or incomes in that other income category. Almost the sky's the limit. So that's another, and that's really all your income. That's going to be your gross potential rent minus your losses, and then plus your other income. And say your other income is 20,000. So we went from 100,000 down to 90, up 20. So we're at 110,000 in income revenue for the month. So that's the first part of the NOI equation. The second part is the expenses, and specifically operating expenses. And the operating expenses, the difference, there's two main types of expenses: operating expenses and capital expenses. Operating expenses are the expenses that it takes to run the day-to-day operation of the property. Capital expenses are generally one-off. You have a roof to repair, you have to lay out flooring in one of the units that you typically don't replace every year. And so this is where it can get hairy, what you consider a capital expense versus operating expense, to try and boost your NOI, because everything is centered around the NOI.
There's definitely you could definitely have a couple expenses that are almost considered gray areas.
Mhm.
You know, I've looked at deals where the capex was so high that the turnover and the repairs and maintenance were amazingly low, and you had to back some of that capex out, or at least add a certain buffer. That as we get into future episodes, we can talk about what that buffer is.
Yeah. Generally speaking, what I consider a capital expense is, one, you budget for it in your due diligence. So, and if you have like an LTC loan, which we'll get into at a later episode, that LTC is loan to cost, where they cover part of your capital expenses. If you have something designated already for that, that would be a capital expense. If you don't, I mean, that's when you can get into the gray area, and it's a very big gray area. Sometimes you say, and ultimately it's a decision, an executive decision on the ownership team and the property management team. It's like, well, this could be a capital expense or it could be an operating expense, and then usually one of you has to put your foot down.
I would say that you would also discuss it with your accountant as a possibility.
Yeah. The some of the main operating expenses that you're going to see is if you have a property where you have on-site staff, your biggest operating expense is going to be your payroll. Your payroll mean the property pays for the employee. So they're paying their salary, they're paying their benefits, workman's comp, everything. I mean, it's a real job. So they have benefits and everything. So the property pays for that. So if they're bringing home a salary of say 45,000 a year, their benefits and everything might bring it up to almost 55, 60,000, depending on what services they get. And the thing with the payroll is unless you're self-managing, that person is on the payroll of the property management company. So they really get to dictate all their benefits and everything, and the owner has to pay for it. Some smaller ones are general and administrative expenses. This could be like your phones or
A new
copy
computer.
machine, new computer, everything. You have marketing and advertising, and this really would depend on like your occupancy. So if your occupancy is sitting at like 97, 100%, you probably aren't needing to market it very much. But when you're dropping down in the 80s or below, you are probably really hammering marketing. You're trying to get everybody's eyeballs on your property so that they'll come in and rent from you. Maintenance and repairs, this and turnover costs also. So I've seen um, properties where there'll be maintenance and repairs and have zero turnover, or I see like maintenance repairs plus turnover. But this is a big gray area with capital expenses. There's a repairs and maintenance and turnover costs. So, and then we'll get further into details in that later. You also get contract services. This could be like your internet, your landscaping, your trash. If you have, well, trash could be separate. Um, Suppose you have a security system, you have cameras up and everything, and that costs a monthly subscription. That's all your contract services. Then you have, you'd say, your utilities, which could be like your trash, your pest control, electric, water, sewage, natural gas, and any of the other miscellaneous fees associated with utilities. And then one of the next biggest expenses is your property management fee. So yeah, you're paying the on-site staff, there's payroll, but you also pay your management company. And if you have on-site staff and you're paying payroll, then you're probably paying like 3 to 4% for your property management company. But if you don't have on-site staff or you're not paying payroll, then that property management fee will go up to like 10% or more.
Yeah.
Then you
When you're
have,
talking about the biggest expenses, I'm thinking about some of the real big ones that we haven't even touched on yet, such as the big two that I've heard a lot of people lately, obviously, are property taxes and insurance.
yeah, so property taxes and insurance are basically your two uncontrollable ones. I mean, you have to pay them regardless. Insurance and taxes, you can protest them, you can try to get them down as much as you can, but generally speaking, you have to pay them. And yeah, ultimately, those generally are the biggest, especially combined. Is your property taxes, um, and you can, if you're in a city and you pay county taxes, city taxes, if you have a property in another city, you have to pay other taxes. Everybody wants a piece of your property, so you have to pay that. And insurance, depending on where you invest. Um, Florida insurance is like through the roof if you can even get insured. You go up into say uh, Ohio, Nebraska, New Mexico, places where there's like not a whole lot of weather happening, your insurance is actually pretty decent. not too bad. Um, I invest in North Texas where we have lots of wind and hail and tornadoes. So guess what? My insurance is pretty high. Not as high as Florida's though, but still pretty high.
I've seen anywhere from, in the past 2 years, I've probably seen anywhere from $300 per unit per year in places like maybe Arizona or New Mexico, all the way up to $1,400 per month, per unit per year in other markets
I've seen up to about 25, 2,600 in
in
Florida.
Florida. Yeah, I haven't looked at many Florida deals lately.
And that's generally like on the coast of Florida. Inside, like we're in the middle of Florida, that central part, you're back down to like 1,400. So, but and where I am in North Texas, we're right around the 1,000, 1,100 mark. So those are the main operating expenses that you're going to see, especially in multifamily investing. And so that's the second part of the NOI. And suppose you have expenses of, let's say, 55,000 a month. So right now we're coming in at 110 minus 55. So we're right at the 55 or 50% mark. So that's your expense ratio, all your expenses over all your income. And so then that would be 50%. That's not too bad. Depending on if your all bills paid or not, that could be improved. Um, ideally, ideally, we would like in the 40s, 45 or so, but we've seen our property get up into the 60s regularly, and we try to bring it back down to the 50s. So,
There's definitely some markets where you average higher or lower, and like you said, depending on what the utility costs in the market are. If you look at places like in the Southwest, I have definitely seen 30 to 35% expense ratios, which actually weren't completely unheard of. But if you're in other markets, it could definitely be in the 60% expense ratio all day long.
and one thing to keep in mind is it also depends on the age of the property.
Yep.
If you have a brand new Class A, your expense ratio could be a lot lower than if you have a 1960 build C class property.
So when you're underwriting, one of the main things you would say is that if there's a Class C property that we know needs work, and somebody's trying to sell it to you with pro forma or with numbers that are like at a 30% expense ratio, that's probably a red flag.
Definitely. So right now, just going spitballing some numbers off the top of my head, we're sitting at a 50% expense ratio. $55,000 a month would be our NOI. If we annualize that, or if we multiply that out by 12, we get 660,000 a year for the NOI. So, um, and a lot of times you'll hear people say, well, this is above the line or this is a below the line calculation. The line that they're referring to is the NOI. So you have 55,000, yeah, 55,000 for the month of your NOI. And then you have all your below the line expenses as well. And we'll get into more of that later, but this is where your debt service comes in. So you have to pay the bank from your NOI. You have to this is where your capital expenses come in. If you didn't cover them and bringing in reserves specifically for them, then you have the 55,000 minus your debt service and whatever left to pay your capital expenses. If you're taking an asset management fee, that's generally below the line expense. And really, that's the main below the line expenses are the debt service, asset management fee, and capital expenses.
Well, the debt service is usually the biggest one, and then CapEx is number two. So yeah.
Yep. So so that is the NOI. And we'll deep dive into other terms and how to do some quick calculations using the NOI in our on the next episodes. So thanks for hanging out, and we'll catch you next time. You have anything else to say, Frank?
No, thanks.
All right. And that's a wrap for this episode of the Ironclad Underwriting Podcast. If you got value from today's conversation, make sure to subscribe, rate, and share the show. And don't forget to connect with us on LinkedIn, YouTube, Facebook, Instagram, or check us out at our website at ironcladunderwriting.com for more insights and updates. If you have a question, a deal you're analyzing, or a topic you want us to tackle, shoot us a message. We'd love to hear from you. Until next time, keep your assumptions grounded, your models sharp, and your underwriting ironclad.